Hello and welcome to CIFS FinServ Now, and we are live. My name is Tiffany Fletcher, and I'm the Executive Director of CIFS, Council for Inclusion and Financial Services. And I am super excited for today's webinar. Today, we are talking about unlocking innovation in home ownership. Our special guest today is Jeremy Foster, Chairman of Calque Incorporated. With a stellar reputation and wealth of industry experience, Jeremy will delve into the inner workings of Calque Incorporated, shedding light on their groundbreaking approach to home buying. Jeremy Foster has nearly 20 years of C-suite experience, primarily in the banking and real estate sectors. As a collaborative and data-driven leader, Jeremy has served as the Chief Financial Officer and Chief Operating Officer at several Fortune 500 companies. At Casasa, a FinTech 100 firm, he led analytics and was general manager for a $25 billion deposit product portfolio, distributed through 700 banks and credit unions. Wow. Before becoming CFO and helping guide the company through a sale to private equity. As the founding CFO of Homeward, he was one of several key players in the creation of the power buyer segment of the real estate industry. And as the founder and chairman of Calque Incorporated, he created what has become the dominant buy before you sell solution distributed in partnership with established lenders. So impressed and so excited to welcome Jeremy to our broadcast today. And before we dive into some questions with Jeremy, if any of you in our listening audience have any questions, please make sure you put them in the chat and we will answer them at the end of the session. Hello, Jeremy.
Thank you for that fantastic introduction. Really excited to get the chance to chat with everybody today.
We're excited to have you, Jeremy. So I guess we'll dive right in, and we'll start with just asking you the question about what does Calque do? Talk to us about that.
Calque works with established, experienced lenders to remove the home sale contingency from the debt to income requirements when you're underwriting a borrower for the mortgage on their next house. And that's a pretty powerful thing that has really swept through the real estate industry, starting with real estate agents over the last couple of different, there've been two big waves. Some of y'all may have heard of a company called Open Door, Zillow Offers, Redfin Now, a pretty terrible business model, incredibly expensive for consumers, and the companies that do it still don't make any money either. And they disintermediate real estate agents and loan originators by buying the old house from the customer on demand at a discount, and then they flip it to somebody else. It's very expensive because it costs a lot of money to buy and sell a house, so doing it twice costs a lot of money. And it's really, it's a painful solution financially, but it's a wonderful solution for consumers from a convenience perspective, because that means they can make an offer on their next house that's going to win. So that was kind of the first big wave. And then the second big wave is the power buyer segment, where you had a bunch of companies like Homeward and then Homelight and Fly Homes and Orchard and a bunch of others. And what that model is that's buying the next house for the customer and leasing it back to them. And then when the old house sells, you can sell them their next home. Calque solves that problem a lot less expensively, and we do it by solving the problem where it sits, which is in the debt to income requirements. And so if you really think about what makes it tough for a homeowner to move, there are a few things in the real estate process where the mortgage processes that we have interfere with the real estate transaction. And the biggest of those is that you make these contingent offers. And so if you're the person trying to buy the house and you've made an offer to someone that says, hey, I love your home, we want to buy it, I've been pre-approved for a mortgage, but I've got this home sale contingency, so I can't actually close until I sell my house. And then that
Mhm.
person you're trying to buy the house from, they have your offer, and then they have another offer from somebody else where they've come up and they said, hey, great, I've been approved, there's no contingency, I can close in 3 weeks. If you're the person selling the house, there's no question which of those offers you're going to take. And the net effect is that non-contingent offers are about 4 times as likely to win as a contingent offer. When a contingent offer is able to win, they're typically going to pay between 3% and 11% more than a non-contingent offer would to win that next home. And then a non-contingent offer gets a dramatically better consumer experience. So, as lenders, we're very close to the consumer through the financial part of that transaction, but real estate agents are the ones that are really close to the consumer through the experience part of that transaction, because they're the ones that are going to call an average of 14 times and say something to the effect of, great news, we've got a potential buyer for your home. Kick the dog outside, shove the kids in a closet, run downstairs and scrub the toilet, and I hope you didn't have any meetings this afternoon because I'll be there in 2.5 hours, right? And so it's a pretty painful experience. So what Calque does is we partner with lenders to make a binding offer on the departing residents. That binding offer meets all of the requirements that Fannie and Freddie have to allow a lender to say, okay, there's an offer, that home is going to sell. I can exclude it from debt to income, and I can originate a non-contingent mortgage on the next house, and the buyer can buy before they sell and move into that home. Unlike Open Door and those other companies that are in the iBuyer space, however, we give the homeowner 5 months to sell that house to somebody else. So
Wow.
the beauty of that is that with the 5-month period, they're not taking our offer is discounted. Our offer is a heavily discounted offer, but we're not hoping to buy the home. We charge a fee that's a fraction of the losses that the consumer would experience if they sold their house to Open Door. And so in general, for most consumers, the way that process looks is they would probably lose $50,000 versus a traditional process with Open Door, not get to work with their real estate agent and not get to work with their lender. They would pay about $20,000 to $25,000 with the power buyer process. Cost of moving from a $400,000 home to a $500,000 home with Calque is going to be about $5,000 or $6,000. So dramatically less expensive. And they get to work with their lender, and they get to work with their real estate agent.
Wow, definitely a unique concept, and it does save, to your point, it saves the consumer money. Does Calque, I know you mentioned all 3 of these, but I'm just wondering, does Calque work primarily with agents, lenders, or home buyers? Who's the primary kind of focus?
So we view the customer as our lending partners as our primary customer, and
Okay.
the borrower is their customer, and the real estate agents are partnered with both of us. We never interfere with the real estate agent's commission. We never interfere with loan originator underwriting standards or lender underwriting standards. You can really think of it as a guaranteed offer on the departing residents, and everything else works the way that it normally would. And it's a pretty seamless process, and it's a lot less work for real estate agents than the other 2 processes, where typically a real estate agent might be having to fill out duplicate sets of paperwork, right? They've got to flip a house an extra time. They don't have to do that with Calque. And so, the lender is our primary customer, but we very much view the loan originators and the real estate agents as partners. And then we do work with the consumer. We tackle all of the conversations, all of the agreements, everything that's related to that binding offer on the departing residents. We have a team of customer experience specialists that handles that, and they coordinate with the LO and the real estate agent through the process.
Well, that's great. I'm just curious. You mentioned that you give the home buyer 5 months to sell the property. Do you have any insight as to kind of what percentage of the time they are actually able to sell their home within that 5 months?
Last year, 94% of the homes that we made offers on sold to someone else. We bought it 6% of the time.
That's
And
awesome.
most of the time, if we're buying the home, after 5 months, that, most of the time that means we probably overvalued the home and paid too much for it. So, um, it's typically a function of appraisal variances. And so we lose money in that
Hmm.
circumstance sometimes.
Hmm.
And then if we do make more than our fees, interest, all of that other stuff on the departing residents, if we do resell it at a gain, which hasn't, in all candor, has not happened yet, but if we do that, we will end up giving that difference back to the consumer.
That's wonderful. Um, what changes have you seen in the marketplace? I know it's kind of interesting right now, the economy, the market, and how have those changes in the marketplace impacted the company, and how has the company adapted?
Great question. So I'd say there are a few things going on in 2024 that we did not see in 2023. One is the degree of variances in appraisals has widened a lot, and it's widened a lot um, both in terms of what all the automated valuation models say, what individual appraisals will say, and how those fit not only across and against each other, but against the actual realized price of the home. So, we still kind of systematically see about a 3 to 5%. Appraisals tend to be about 3 to 5% higher than what homes actually sell for. But then in addition to that, we see in some instances an appraisal might be 25% high or 30% high. And some of that is the fact that we see these pockets of, different regions where, particularly areas where you had a lot of demand and very limited supply. So you had these huge spikes through 2021 and 2022. They had massive home price appreciation. A lot of those markets are coming down today. Austin, Boise, you're seeing a lot of this downward pressure on home prices in those markets. And a lot of that is just that excessive demand is still supply constrained, but where they had 15 offers on every house, now there may be 2, and that makes a big difference. So that's
Absolutely.
probably big trend 1. I'd say big trend 2, um, you know, it, interest rates have certainly put pressure on affordability. When you look at the median income that was required to qualify just for the mortgage on the next home, um, 4 years ago was $59,000. If you had $59,000 and you didn't look at any other forms of debt, that $59,000 in income was enough to qualify you for the mortgage on the next home. Today, that's 106 grand. And that's a combination of home prices have gone up and interest rates have gone up. And so affordability is a real issue. And so we see people a lot of times really trying to find every alternative they can to try to get their payments to a manageable level. So people are beginning to tap into home equity, which is another avenue for Calque to provide values. We have a number of lenders that provide a second lien on the departing residence that makes a bigger down payment on the next home and can help pull those mortgage payments down to an affordable level for borrowers. And so that's another big trend. And then I'd say probably the third really significant trend that we're seeing is lots of extension in terms of the length of time in some markets, but not in others. The amount of time, days on market, is becoming a lot more volatile as well. And obviously, since we have kind of that 5-month guarantee, that has a big impact on us. And so we tracked all of that. And then as far as how we've navigated it, one of the biggest is we've reduced our offers as a percentage of the appraised value of a home, because those appraisals are more widely varying. But we've put that guarantee in place for borrowers that if we sell a lot, if we sell the home for a lot more, then they're going to get money back. And so that reduces a lot of their apprehension and allows us to continue to maintain a really strong close rate and acceptance rate from the consumers and from the borrowers, because we reduce the risk for them, but we're also reducing the risk for us that we buy the house for more than it's worth. And so that's probably the biggest change we've navigated. And then, the other thing, we've had such a huge surge of applications and new lenders. We're just, as a company, we're having to adapt to volume. We came into the year with, I think, 4 live lenders January 1st, and now we have 18 live and 23 signed MSAs. So we've got 41 total. We got 41 total lending companies with over 4,000 loan originators between them. That we're in the process, that are either live or getting live. So it's very much one of those, like, you work 4 years and then all of a sudden it feels like an overnight success. But you work 4 years and there's, the floodgates open. And so for us, handling volume has been another big change for us to navigate. We've tripled the size of our customer experience team, and we've added account managers. And so we've done a lot to continue to make sure that we have a top-notch experience for borrowers, for loan originators, for agents, and for our lending partners.
So it sounds like you're getting really good traction, and I guess I'm just wondering, like, what other initiatives do you hope to launch, or are you considering to make sure, you either maintain the traction that you have, and I'm assuming likely also working towards increasing the traction that the company is getting?
Great question. So our primary focus is on continuing to provide a high quality experience for our partners. And our longer term partners, when you look at the percentage of loan originators that use the program, it typically takes a while for like you get a branch manager that uses it and then they're like, oh, this is great. And then they roll it out to the rest of their branch. And then those LOs take a few months to try it and they're like, oh, this is great. And then they come back again and again. And so we're with the new surge of lenders that we've just added, we've gone from having about 35% of the loan originators at our lending partners having used the product. We added all these new LOs, and now we're back down to about 4%, not because the number is shrank, but because the amount of to be activated people has gotten so big. And so we're in a phase now where we're really trying to make sure that we have consistent training, lunch and learns, helping our lending partners and LOs build deeper relationships with the real estate agents in their neighborhood or in their market areas. And so those key experiences are a big part of what we're rolling out now. Really, as far as the momentum for lender acquisition, I don't think we have to do much. It's our word of mouth has been driving unbelievable sales activity. We're signing up right now about 1 to 2 new lending companies a week. And so today it's really just, how do we continue to make sure that we're providing a really great experience for everybody? And then how do we make sure that we're training and activating the loan originators at our current partners?
Question in regards to your lender acquisition. So when you're thinking about, you talked about how the numbers are kind of fluctuating. You've got so many kind of waiting to be onboarded. Are you seeing any concentration in particular markets for coverage as it relates to the lenders that have actually signed up and that are working with you? Or do you feel like you have coverage and representation across the country?
So we work in 48 states. Our program works. Technically, we could work in 50 states. We don't go to Alaska and Hawaii because I can't pull anybody offline long enough to hop on a plane for a 3-day round trip. So but we're live in 48 markets. We have lenders live in 48 states. I shouldn't say 48 markets. We have lenders live in 48 states, not markets. And then I would say we do still have a lot of concentration where our first lenders got started, because sometimes part of what's happened is these big nationwide lenders partner with us, but the people that helped drive that lender to come over was, it might have been a loan originator who was competing with one of our existing lending partners, and they were like, hey, this isn't fair. How am I supposed to compete when they can get rid of the contingency? So at an activation level, we see lots and lots of activation right now, I would say, in kind of the South, Southwest, Colorado. We're really kind of in the middle of the country. We do have some activity on the coasts, California and Florida, because we had some early lenders with presence there. But Virginia, the Carolinas are starting to pick up some traction for us. Texas, Colorado are big strongholds for us. So I think it's where some of our competitors started on the coasts, have now copied our model and are trying to come in. We kind of started in the middle of the country and are starting to expand out.
Got it. Well, what questions should lenders ask you or others about the solutions that are offered by Calque?
Great question. So the first is, how are you from a compliance perspective, right? And we're compliance, like very compliance centric. We started the solution, we did all the legal work and everything to build the solution. We've got competitors who are now attempting to copy that, but they don't always do their homework at the same depth, right? It takes more expertise to build something than it does to copy it. So that's and we've been validated as purchasable by Fannie and Freddie. We're compliant with TILA and Reg B. A lot of our lenders are not. We're RESPA compliant, or a lot of our competitors are not. A lot of our we're RESPA compliant. A lot of our competitors are not RESPA compliant. So there are a lot of things that you should ask from a compliance perspective. The second big question I would say is from the perspective of a lender, and as an executive team at a lending company. One big question is, can you trust that this is a partner who's truly going to be a partner from the perspective of, or are they built to partner, and do they have all the supporting technology and capabilities and all of that I'm going to need to be dependent upon them to provide a good experience for my loan originators, my borrowers, real estate agent partners, all of that. A lot of our competitors started as lenders themselves, and so in many circumstances, their processes, they're trying to repurpose their own mortgage origination process, and in some instances, they may shoehorn that in on top. And there are what I sometimes call dangly downy bits, right? There's little places where you're trying to fit two puzzles together, and there's a rough edge of the wood that those two things don't sit flush. And so that can create friction and a less than ideal experience for LOs and agents and consumers. We built from the beginning. We were never a lender. We knew we never wanted to be a lender. We knew we wanted to partner with lenders, and we held to that even when for 2 or 3 years, it probably would have been easier for me to buy a mortgage company than convince our first partners to give us a shot. And so, but we held true to that, and we built a process that just runs alongside and in parallel, and it's very clean and easy, and we don't interfere with any of the underwriting standards or any of the underwriting decisions. You get a custom branded microsite with your logo, your colors, all of that. When they pop in, they get to input the name of the LO and the real estate agent. We never remarket, so we're never going to try to steal your customer the way others might by saying something like, oh, well, yeah, the fee is X, but it's X minus 1% if you use our mortgage company instead of your mortgage company. And so it's a very clean and elegant process. The customer comes in, it's a 3-minute and 47-second application process on average. Then we handle the piece on the departing residence. We coordinate with you all the way along. And then at the back end of our process, you're going to get a purchase agreement that you can use the same way you would any other purchase agreement to exclude the departing residents from debt to income. So very clean, seamless partnership that puts you front and center and elevates your brand. So that's the second big thing, is who's going to end up being the person in control of the borrower through this relationship. And then the third big question I would ask is, can you trust that when mortgage is a fun place to be again, the people who were competing with you for that mortgage business 2 years ago aren't going to suddenly decide they want to compete with you for that mortgage business again, right?
Mm.
And so I think that's a really meaningful question. I don't know for sure what's in the minds of my competitors. I know that they did not build the solution to work in partnership from the beginning. And I know that they decided to be partners when mortgage got hard.
Wow.
So those, I think, are three big questions.
All good questions. Just one more. I would just say, what would you say you're most proud of as it relates to either the mission of Calque or the accomplishments to date? How would you summarize it? You are most
I'd
proud
say
of?
there are two things I'm incredibly proud of. And our mission is a dual mandate. The first is, if you look at the trends that we've seen in terms of who owns residential real estate in the US, lots of institutional buyers have been pricing homes out of reach for the people who just want to live the American dream, right? What's the American dream? White picket fence, pup in the backyard, 2.5 kids. Like that white picket fence is an important part of that dream. And the trends that we're on are that by 2030, as much as 40% of residential real estate in the US may be owned by institutional buyers, and we're becoming a nation of renters. And part of the reason for that is because of this contingency, meaning that people who want to participate and people who want to make competitive offers, they either have to pay 3 to 11% more, or they're just priced out. They don't get to compete with cash offers. And so that is an important part of our mission. The other is, I believe very passionately in the role that local lenders play. And whether, by local, I mean whether you're a nationwide lending firm and you've got local branches, or whether you're a local regional company, like there's independence in that, and there's a competitive part of our ecosystem that is not the case when you see big institutions gobbling everything up. And so I've spent a significant part of my career either as the COO of a $500 million community bank, or as the CFO of a financial technology company dedicated to helping community banks and community lenders compete. And so we have some wonderful national partners, but they are there to preserve and maintain a competitive environment that makes sure that consumers have choice. And so that's another big thing for us, is building a robust network of lending partners and giving them the tools and the weapons that they need to compete with these big institutional buyers.
Wow, that's awesome. Talk about, innovation in home ownership that allows consumers to have a choice. I think that's so critically important, especially in the current environment. And thank you, Jeremy, and the work that Calque is doing to further that mission and objective. Just in case there are any listening, I know you have a website. What's the best way for lenders to reach out to Calque if they're interested in becoming one of your providers?
If you want to learn more, you can go to Calque, Calqueinc.com, calqueinc.com. And there's a lender section that you can look up there. And if you would like to schedule time to learn more on a webinar, just zip me an email. It's Jeremy, Jeremy, at Calqueinc, CalQueinc.com.
Well, Jeremy, is there any final point that you want to share with those in our listening audience today? Anything
Just
else?
thank you so much for having me on, and thank you so much for the work that you're doing with the Council for Inclusion in Financial Services. I think it's an important mission, and really appreciate all the effort and energy you put into that.
Well, thank you so much, Jeremy, for joining us today. And I want to thank our listening audience. I was looking to see if we had any questions that were submitted, but I don't see any, because I know Jeremy did an awesome job providing an overview of Calque and answering our questions. And as he mentioned, if you're interested in getting more information, just reach out to him and we'll have that information on our site at the conclusion of this webinar. But looking ahead, we're excited to announce the upcoming FinServ Summit of 2024 that's going to be happening in Plano, Texas on June the 20th. This summit serves as a hub for housing and economic insights, fostering collaboration that propels progress. Join financial services professionals from across the region as we dive into market updates, sponsor highlights, and best practices to elevate your organization. Registration is now open. The cost is only $59.95. And if you go and visit our website at councilforinclusion.org, you can secure your spot and discover more about this invaluable opportunity. One additional note for those who are unable to join us in Plano, our last stop for the 2024 year will be in San Diego, California on August the 22nd. And we want to thank you once again for being part of our FinServ community. We eagerly anticipate seeing each of you in Plano on June the 20th for what promises to be a transformative event. Until then, stay engaged, stay inspired, and let's continue striving for inclusivity and excellence in the financial services industry. Thanks again. Bye-bye.